Hey there, it's Dave Keller here with Market Misbehavior. Today we're going to talk about 3 ETFs that suggest further downside to come. So the S&P 500 really has been in a choppy, sloppy, sideways environment. Really, it comes down to, June, July was sort of the end of this rally phase for now. And from there, we've sort of been chopping around in this area. Now, I've heard people ask about, what pattern this might be representing. Some have called it, a pennant pattern or triangle pattern of higher highs and lower highs and higher lows. I would describe this as a potential head and shoulders top. And here's how that works, right? A head in the top, a left shoulder, a right shoulder. It's not an ideal pattern, but it certainly has the look of a potential head and shoulders top. Now, a head and shoulders top is only confirmed when you break through the neckline. So the S&P getting below 4350 would complete that breakdown of the neckline, and I think suggests much further downside potential for the S&P 500. With the NASDAQ and others, you're seeing similar sort of consolidation periods, with a lot of them suggesting some clear levels of support. As long as those hold, things are still okay. If those levels break, things get concerning. What's interesting, though, is if you look at some other ETFs, we'll talk about semiconductors, homebuilders, bond prices, also suggesting some further downside may be coming. Before we get to those charts, do me a favor, like the video if you could, subscribe to my channel if you wouldn't mind. It would help me a great deal. I'd love to get the good word of technical analysis and behavioral investing out to others. By liking the video and subscribing, you certainly would help me in that effort. Also, before we get to the charts, one more thing I wanted to tell you about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model, or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha, or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so we're going to start with the chart of semiconductors, ticker SMH. This is one of the more common semiconductor ETFs. Now, what's interesting about the chart of semiconductors is they've put in a lower peak here at the beginning of September, right around the Labor Day holiday, and that comes after a pretty good uptrend. So what have we seen that has suggested a rotation from a bullish phase to more of a negative or a bearish phase? Well, I would argue what we've been in most recently is more of a consolidation phase, just like the S&P chart we showed in the introduction, sort of in that choppy sideways move, not quite breaking down yet, but showing signs that that may be coming. I think we've seen some warning signs from semiconductors as well. Let's talk through a couple of those together. Look at the low in October up to the high in July, right? Particularly as this trend has been going higher highs and higher lows, warning sign popped up in July. And if you look at the peak from June to July, higher highs, look at the peaks in momentum, or what's called RSI, right? Higher highs in price, lower peaks in momentum is what's called a bearish momentum divergence. That usually indicates an exhaustion point or an exhaustion sign for a bullish phase. Suggests we're in the 8th or 9th inning as opposed to the 2nd or 3rd inning. Now, what happened after that point? Well, what's happened in the last 6 weeks is we've now put in a clear lower high. And after this week's drop for semiconductors, particularly the weakness on Friday, we've now established a lower peak around 157. This undercuts the high in July. Now, as Charles Dow taught us many, many years ago, an uptrend, a pattern of higher highs and higher lows. A downtrend, a pattern of lower highs and lower lows. If we start making a lower high, if we then make a lower low, that would complete that potential rotation. So I could see this as an accumulation phase or an uptrend phase, then more of a consolidation or a sideways phase. Now we're potentially breaking below that level of support. What's also interesting is if you look at a trend line off of the major lows over the last 8 to 12 months, we can do this, right? So this is taking the low in October of last year, lining that up with the low in late April. That lines up with a couple retests of that trend line in May. Once again in August, we bounced off of this level a number of times. Then about a week and a half ago, we gapped below that trend line support and now have continued lower. So the bearish momentum divergence, a lower peak, breaking trend line support, breaking the 50-day moving average. So now instead of finding support at a 50-day moving average, we're now below a 50-day moving average, which is now flat and almost starting to slow down. Look at this last rally in the semiconductor ETF in late August. You can see that the RSI never got above 60. And in a bearish phase, the range of the RSI often drifts lower. Rallies rarely get above an RSI of 60, and sell-offs tend to go below 40. That gets us to where we're at right now. Going into next week, do we hold this level of support right around 143 for the SMH? If that breaks down and if the momentum gets worse, if the RSI gets below 40, I think that could complete a potential rotation much lower. Now, how much lower? Well, this is one of the common techniques you can do, is basically look at the pattern. So if we take this as sort of the range from that point to this point, it's kind of the height of the basing pattern, sort of do a similar move lower would take us kind of right to there. This would be around 127. This is basically just saying an equal percentage move from the height of this base to some sort of breakdown. That would take us down to the high from February of 2023, right around 127. It would take us just below the 200-day moving average. So that sort of move, not unreasonable in the grand scheme of things. Long term, that could still be a fairly constructive chart, but it would suggest further deterioration in September into October, set us up maybe for a nice rally in the fourth quarter, but for now, still showing some signs of weakness. Chart number 2, homebuilders, ITB. This is one of the home construction ETFs. ITB and XHB are the two I like to follow. Similar ETFs, to be honest with you, but just different weightings. Some of them more in the Home Depot, Lowe's kind of, home construction, home retailer, kind of a home improvement retailer type of a space. Others more pure home builders. That's why I start with the ITB. Again, called a home construction ETF. It's really a play on home builders like Lennar and D.R. Horton and Toll Brothers and things like that. Similar look to the chart of the semiconductor ETF, SMH, and this one may be a head and shoulders top type of pattern, but it's kind of a weird head. It's not an ideal situation. A classic head and shoulders pattern has a clear head, a left shoulder, and a right shoulder. So I don't know if I would label this a perfect head and shoulders pattern by any stretch, but I certainly would say it's an illustration of a topping pattern. The reason is because as we rallied up here, again, look at the uptrend, higher highs, and then all of a sudden we stopped making higher highs. It stalled out around 89 in mid-July. A number of attempts to get above 89 all failed, right? We kept pulling back. Then we broke below the 50-day moving average. We tested that from below, and now we're rotating back to the downside. Right now, you can connect the low from early July to the low in late August. We're right there as of this week's Friday's close. Right? Friday's low is right about that level. Next week, we break below, we'll call it 81. That would complete that rotation and then suggest further downside. Again, do that same measurement technique that we talked about with semiconductors. Take the height of this basing pattern, just a simple, easy kind of way of thinking about it. It's about a 9.5% range from top to bottom. Project that from a breakdown level. That gives you a downside objective. Same point as SMH in terms of the February high. That actually lines up with the low from late May. That would take us right around here, right around $73 a share, just below the 200-day moving average as well. Note the momentum, which is very similar. On this most recent rally in late August, we made a lower high, and also the RSI never really got above 60. Notice how the relative strength on both of these groups, by the way, has rotated lower because the weakness is actually outpacing the deterioration in the S&P 500, the major averages as well. This third one is kind of an interesting one because this is looking at the AG, which is an aggregate bond ETF. Now, when we think about bond ETFs, there's sort of three big broad bond ETFs that I like to track. TLT is a long treasury bond ETF. LQD is a corporate bond ETF. And then AG kind of mashes those together. It's aggregate bonds, corporates and treasuries, all mixed together. And it's based off of an index used to be called the Lehman Ag Index or the Lehman Aggregate Index. It was a widely followed bond market benchmark produced by Lehman Brothers. Once that sort of folded, it became the Barclays Ag and then the Bloomberg Barclays Ag, and I don't remember what it's called now, but probably something along those lines. This aggregate bond ETF, AGG, kind of tracks that same index. And again, in ETF forms, they're pretty liquid, pretty easy to track, and use as a proxy for bond market performance, bond prices, not bond yields. So if you look at the ag, look at what's happening. While the semiconductor and homebuilder ETFs have been in a pretty good uptrend since the October low to where we're at now, the ag ETF has actually been trending downwards for the last 5 months. Look at the high in February. Now, while those other ETFs actually made new highs in March, April, May, June, July, the ag actually retested that resistance level in April, once again in May, and failed to get any further. From there, we've been in a pretty clear downtrend of lower highs and lower lows. I drew a trend line connecting the high in May, connecting the high in July. It's just above current levels, right around 97, we'll call it 96.50 or so as of the end of this week. Look at the 50-day moving average, which is this blue moving average. We broke below it here in May, had a couple attempts to get above it, but failed every time. Look how many times here in the last 6 months we've rallied to a descending 50-day moving average and then failed. That's kind of where we're at right now. I drew a trend line connecting the low in March, the low in August. It's right around 94.50, not too far below current levels, about $1 lower for this ETF ag. We break below 94.50. I think that completes a rotation below support. Again, take a very simple measure, height of that pattern, project it from the low. It basically would suggest a retest of the October 22 lows for the bond market ETF. Notice the momentum, which has been basically in a bearish phase this entire time. No change there, still suggesting a pretty good downtrend in rates. So we've been heading downwards. I think we get below 94.50. I think that completes a confirmation of further downside potential. Now, if bond prices are going lower, what does that mean for interest rates? They're going higher. If you look at $TNX on the StockCharts platform, that's an index that tracks the 10-year Treasury yield. So if bond prices are going lower, that means yields are going higher. If you think about the S&P 500, it bottomed out in October of last year. Look at the bond market. You can see that interest rates actually topped out in October of last year. Trended downwards for about a 6-month period. And I drew a trend line connecting the peak in yield in October. Again, here in early March, you can see we broke above there at the end of June. We retested that in mid-July and then rotated higher. So we now are making a pattern of an uptrend pattern of higher highs and higher lows. I drew this resistance level from March of this year, lines up with July of this year. We broke above there in August and then finally resolved to the upside. We retested that level right around 4.1% in late August, early September, and now rotated back to the upside. So yields have been in an uptrend. So what does it mean if bond prices are trending downwards, if yields are continuing to go higher? And again, we have the Fed meeting next week, which could change the look of yields very much or could confirm even further upside for the 10-year yield. Now, what does that mean for semiconductors and other growth stocks? Well, it usually means not a good thing for those areas, right? Higher rates tend to be more of a headwind for growth stocks than a tailwind. So higher rates from here, certainly rates continuing to trend higher, bond prices trending lower, would indicate more likely scenario that groups like semiconductors, growth stocks, rotate lower as well or continue to rotate lower. That would probably mean the S&P, the NASDAQ, and other growth-oriented benchmarks most likely trading lower. So on the S&P, again, I'm eyeing 43.50 as a support level. If we break that, I think that completes a pretty ideal head and shoulders topping pattern for the S&P. But given the weakness that I'm seeing from semiconductors, from home builders, and from bond prices, I think a breakdown may be likely here in September and October. What do you think of these three ETFs, semiconductors, home builders, bond prices? Which of these do you have conviction on and why? Drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.